Real estate investment manager Maxcap Group is doubling down its exposure to New South Wales on the back of what it believes is compelling value. To help us understand why major investors and lenders want more exposure to New South Wales property sector is Maxcap's State Director for New South Wales, David Oudshoorn. Thanks for joining us on The Urban Developer.
Thanks, Adam. How are you?
Very well. So you've described the conditions for lending in New South Wales, especially Sydney, Canberra and Newcastle, as very favourable. Can you explain what you mean by this?
Yeah, that's right. Look, at Maxcap, we've had a really large presence nationally for a while, but particularly in Victoria. And we're really now looking at that Sydney and New South Wales market as the next opportunity. I think, COVID to one side, the economy is performing pretty strongly up here. And really it's about the house prices, quite frankly. The rising house prices make apartments more compelling. And that's where a lot of our funding tends to be directed towards. And also on the capital side of things, a lot of our institutional partners want exposure to the gateway city of Sydney, typically. So there's a real strong push from our capital partners and Maxcap internally to take advantage of those conditions and really look to push hard in this market. And I think too, even outside of Sydney, cities like Newcastle and Canberra, we're seeing as really strong markets and strong opportunities over the next couple of years as well. And again, it comes back to house prices. Sydney is becoming more and more difficult to purchase homes and apartments for that matter as well. So that's seeing some population growth spilling out into those regional cities that I mentioned. I think for us, that's where we see the real growth opportunity for Maxcap over the next couple of years. I mean, Sydney itself has always been quite undersupplied. The supply-demand dynamic with apartment construction in Sydney has always been quite favourable. I think the market up here and the planning regime tends to be a little bit more difficult, and that often leads to the supply lagging the demand. And there's peaks and troughs with that, but I think we've had a period over the last couple of years where the supply has been a little bit behind the demand, and that's really starting to catch up now. And I think COVID has made things a little bit challenging for everyone across the country and across the world. But I really think if we can find our way out of that, then we're going to see some really strong conditions in Sydney in particular, but New South Wales and ACT more generally over the next 24 months or so.
Now, what sort of investors are sitting behind the Maxcap business? You just mentioned before, institutional and others. What sort of investors are sitting behind the business? And how does that actually inform the strategy for where you lend money?
Yeah, sure. Look, Maxcap's probably been one of the first non-bank lenders to start up after the GFC. At the time, it was a really non-existent market and it was very much dominated by the banks. And, it's been a 15, 16-year journey for Maxcap. And that starts originally with arranging capital and often high net worth private investors into mezzanine finance and transactions like that. Over the journey of Maxcap, over those 15 years that I've mentioned, it's very much moved towards institutional capital base now. We're supported by some of Australia's largest super funds, and that's really the primary capital source for us now. And that's given us a number of advantages. It's allowed us to play with bigger transaction sizes. I mean, those super funds are desperate for deployment and they see real estate debt in particular as a great opportunity and a good risk-adjusted return. So they're looking for larger transaction sizes. They've also pushed Maxcap and other non-bank lenders really more towards the senior debt marketplace, which was always dominated by the major banks. So we're doing a lot more senior finance than we used to. And look, still all the way through the capital structure, absolutely. We do mezzanine finance. We've got an equity business as well, but seeing a lot more senior finance. And really, it's driven prices for non-bank finance down as well. When we've got that more mature capital behind us, non-banks, I guess, a few years ago were seen as a fairly expensive option. That was something that developers went to when they weren't able to get bank finance. And I think having that institutional capital behind us has really made it a much more mainstream alternative.
Now let's just talk about sectors and locations. Obviously, some are more attractive than others. Which specific sectors in which specific locations are you seeking to broaden your exposure in New South Wales, and why?
Well, look, I mean, resi development has always been what we've been the strongest in, and that's what we know and we do very, very well. So we're certainly not looking to exit that part of the market. We'll still continue to push very hard in that space. But as we get bigger and bigger and the capital behind us needs that deployment, we've got to make sure we're looking at other opportunities as well and diversifying exposure for our investors. So we see opportunities outside of residential, and that's commercial right now. We see that as a counter-cyclical opportunity at the moment, where we think there's some good opportunity, particularly on the development side of things, where the projects won't actually come online for a number of years, and we all hope that that we return to office working within that period of time. I think likewise we see hotels as a counter-cyclical opportunity right now. And on our equity side of things, we've really made a big investment into the industrial landscape, which clearly is the darling asset class right now that we've seen yields compressing quite significantly. So absolutely makes sense for us to be in that asset class as well. And I think even more broadly, we're considering some of those alternative sectors that perhaps Australia hasn't been all that familiar with over the years: data centres, life sciences, healthcare, those sorts of things as well.
Now, you mentioned that the Maxcap Group invests in debt all the way through mezzanine and all the way up the capital structure. I mean, what influences the extent to which you guys travel up and down that capital stack, and how do you sort of assess that internally?
Sure. I mean, I think that's one of our biggest advantages, that we can partner with developers and our clients to provide the solution that they need. And that's really what drives it. It's our client and what they need. You know, if there's a cheaper capital solution for them by going with a bank, then that's absolutely the right approach for them, and we'll look to partner with them somewhere else through the capital structure. And as you say, being able to do senior, mezzanine, pref equity or true equity just really gives us the full suite of products to be able to sit down with our clients rather than bringing a solution to them. It's about hearing what they need and finding a way that best suits their purpose.
So not one size fits all?
No, absolutely not. It's absolutely not taking a product off the shelf and saying this is all we can offer. It's really, the conversation starts with the other way and the client telling us what it is they're looking to achieve. And it's really about a bespoke solution for every transaction.
Now, there's a ton of liquidity in the market, as everybody knows. Lending conditions are quite competitive. Where do you see pricing going generally over the next 2 to 3 years?
Yeah, look, it absolutely is getting competitive. I mean, as I said, when we first started this business, we were one of the only non-bank lenders, and now there's absolutely lots of choice, and different degrees of choice too. There's some big players like ourselves, and then there's a lot of smaller players filling different needs for different clients. But look, I think that's a good thing. I think the maturation of the alternative lending market for real estate is only a good thing for all of us. It has driven down prices, there's no doubt about that. If you go back 5 or 6 years, probably before the influx of the institutional capital, which is something that the Maxcap really pioneered, I think, as I said before, non-bank lenders were seen as an expensive alternative that you would only take advantage of if you really had to. And that's absolutely changed. Pricing has come in significantly. I think there's a little bit more compression to come potentially, but I don't think there's a lot more. I think we've kind of reached the point now where it kind of works. You know, you've got banks at a certain level, you've got non-banks at a certain level, and the premium differential kind of makes sense now with the additional flexibility that's offered by those non-banks. But look, there's no doubt we've got to make sure we're staying sharp and staying relevant, because it is becoming a competitive environment.
Now, with New South Wales currently in lockdown, and obviously an appetite from your firm to invest in that particular state, what sort of risk is that presenting to the borrowers and to you as ultimately as a lender or a manager of capital?
Look, COVID is challenging. There's absolutely no doubt about that. I think at Maxcap, we've really tried hard to see a way through that. And in fact, in 2020, we had one of our strongest years when a lot of our competitors were pulling back from the marketplace. So really offering certainty and the ability for our clients to transact and still access finance through this uncertainty, that's what really sets us apart, I think. And that's what our clients are really looking for. But look, clearly there are additional risks, and it's something we've got to be cognizant of. I think the fact that we're doing our meetings like this these days and we're not able to go on site and inspect properties quite as regularly as we used to is something that we've got to be cautious of. And look, absolutely, at the moment, construction and getting contractors on site is the key challenge, no doubt. And I think that's prevalent in both New South Wales and Victoria in particular. The government's working hard to make sure that we can really have construction as an essential service that continues through this. But that's the one that I think we've really got to watch. And coupled with that, I suppose it's getting subcontractors and making sure you've got the people on site, but also the cost of materials. That's something that we've really seen rise over the last couple of months, and something that we're watching closely.
So what does it mean? Does that mean you're providing relief to your borrowers at the moment if their sites aren't able to open or as productive as they were?
Look, we only succeed when our clients succeed. So it's absolutely in our best interest to work with our borrowers to give them the flexibility they need to get through these sorts of things. And I think one of the big advantages for us that I touched on is the ability of us to provide certainty to our clients. And that's not only at the front end, but it's along the journey as well, to make sure that they know that we're going to be partnering with them and stick by them through the life of a project.
Now, just a final question on this sort of maturation of the non-bank market. Do you see this split between the banks, the traditional banks, and the non-banks sort of ever coming back together again? Or do you think this kind of two-tiered funding world is here to stay?
Look, I think they will come together. I mean, I could see us participating in bank syndicates in time. I can see the non-bank market continuing to evolve such that we're prevalent in investment lending and other parts of the real estate finance market. I don't particularly see the banks coming our direction, to be perfectly honest. I think they're struggling with regulation and some of the impost that's been imposed, following GFC and other significant events like that. So I think the banks will find their place a little bit at the lower end of the risk curve, and I think the non-banks and other debt funds will naturally sit above that. But there will be some crossover. I've no doubt about that.
Well, we'll always watch with interest. Money's always one of the most important things in this industry to keep it going. So, David, thank you very much for your time, and wish you all the best.
Thanks, Adam. Appreciate your time.